I mean, you're all familiar with total credit as a percent of GDP. But I have to show this figure once again for several reasons. First of all, Mr. Krugman published last September an article, 7,000 words, in the New York Times entitled, "How Did Economists Get It So Wrong?" The title should have been, "How Did I, Paul Krugman, Get It So Wrong?" But the interesting part of the article, he discusses all the economic theories. Half a sentence is devoted to the Austrian school and Schumpeter in a rather negative way. But basically, he doesn't mention in even one sentence the word excessive leverage or excessive credit growth. Then, on January 3rd, in Atlanta, Mr. Bernanke has a speech on monetary policy and the housing bubble, and Fred Sheehan later on can give you all the details and the quotations. But the point again, in 8,000 words, not a single mention of excessive credit growth leading to monetary and economic instability. And I think it should be clear to anyone, if you look at the figures of debt to GDP, the Great Depression was preceded by rapid credit growth as a percent of the economy. But in 1929, total debt to GDP was only 186%. It then went up in the Depression because GDP collapsed. And as you can see, afterwards there was a period of deleveraging, and even in the 50s we had essentially debt as a percent of the economy contracting. In other words, the economy was growing at a faster pace than debt. Also, to be remembered, when the US went into the Second World War, debt to GDP was only 140%. After 1980, debt to GDP begins to expand at a rapid clip, especially after the appointment of Mr. Greenspan, another academic genius. And then under Mr. Bernanke, it explodes on the upside. Between 2000 and 2007, total credit increases at 5 times the rate of nominal GDP growth, and is now at 379%. I have to stress that the difference between 29 and today is not only total credit as a percent of the economy being today much higher. In 29 we didn't have Social Security, we didn't have Medicare and Medicaid and the unfunded liabilities, about which I shall talk in a second. So in my opinion, and this is important to understand in terms of your investment allocation, in my opinion, for as far as the eye can see, the Federal Reserve will never again implement tight monetary policies. They will print and print and print. And of course it will not always work, but the point is they cannot really afford to have a debt deflation in a credit-addicted economy. So they're going to print, and that will have implications on the value of different asset classes, and of course also on the long-term value of paper money or the US dollar specifically. Now it is important to understand a little the philosophy behind US monetary policies. Mr. Greenspan and Mr. Bernanke, they claim they can't identify bubbles, but 15 months ago Mr. Greenspan wrote an article in the Herald Tribune that Spain had a housing bubble, and 3 months ago he wrote about Shanghai having a housing bubble. So in Shanghai and in Spain he could see it, but not in the US. But never mind. So they say we can't identify bubbles, but if a bubble bursts, we can take extraordinary measures and drop dollar bills onto the United States, which they will not do. But in this room, I can print money by dropping bills onto you. Electronically, I can credit each account of yours with $1 million US. So the government that is intent on printing money, they can print money. That should be very clear, especially if they don't care about credit growth and if they don't care about deficits. Let me remind you that again, a week ago, an economist at the University of Texas, James Galbraith, wrote in an interview, said that deficits don't matter. The very week the crisis happened in Greece. Well, with that kind of mentality, obviously, you will have eventually credit problems in the system. Now, okay, the Fed says we can't control credit bubbles, but each time a credit bubble bursts, we can essentially, or we can't control asset bubbles, but we can take extraordinary measures. And this they've actually actively done essentially for the last 20 years. The SNL crisis, the tequila crisis, LTCM. The bailout of LTCM, by the way, was a huge mistake because it gave a green signal to Wall Street, leverage up. There is a Greenspan put, and after 2006, when Mr. Bernanke became Fed chairman, people said, yeah, there's a Bernanke put as well with a higher striking price. So this is essentially what has happened. And the Federal Reserve then also says, oh, we target core inflation. Core inflation, for any economist, is a very incomplete measure of inflation because it doesn't include food and energy. Now, looking at the dining room today, I think that most people eat and that most people need money for transportation, but maybe the Federal Reserve employees don't. So all I'm suggesting is that the Fed essentially targets a very narrow measure of inflation. Now, they had a very fortunate condition for the last 25 years in their monetary policy, which I'd like to summarize as follows. I mentioned earlier on that commodity prices had bottomed out in the 1940s and thereafter had a rising trend until 1980. Thereafter, commodities were in a bear market until 1998, 2001, when they bottomed out. Now, interest rates within the Kondratiev wave follow the commodity cycle very closely. And I have to stress the Kondratiev is not a business cycle, it is a price cycle. So when commodity prices go up, interest rates go up, as happened here between the 1940s and 1981. Thereafter, they went down. In the 1940s, interest rates on long-term treasuries, the 10-year note, had bottomed out at less than 2%. They were still 2% in 1949, 4% in 1960, 6% in 1970, and then they went to a surprisingly high 15.84% on September 21st, 1981. That was a landmark high for interest rates, and thereafter, as commodity prices went down, interest rates also came down. And this is now the big question. We have been in the bull market 1981, and here is the low so far, December 18th, 2008. And now, as you know, interest rates backed up again from the 10 years, which bottomed out at 2.08%, and the 30 years at 2.53%. We went up on the 10 years to close to 4%, and recently interest rates have backed down again somewhat. Now, this is the big question. The deflationists will maintain that interest rates here will go down back to below 2% again on the 10 years, and that the 30 years will go back down to, say, 2.5%. And the inflationists, like myself, we believe that after this long-term down cycle in interest rates, we are somewhere here in a major low area for interest rates, and that from here onwards will go up, and in my view will go up very substantially, because I remember when I joined Wall Street in 1970, there were actually the original Dr. Doom, who was Henry Kaufman of Salomon Brothers at that time, and he was called Dr. Doom because he was forecasting higher interest rates and bonds to go down in price. And there was even a Dr. Des Alvorchnilower, he was at First Boston, and he also predicted interest rates to go up. But I can assure you, in 1970, nobody dreamt that interest rates could go up here from 6% on the 10 years to 15.84%. Nobody. And so I think the likelihood that at some point interest rates will be much higher for reasons of the increasing federal deficit is very high, this possibility. Now, that will have an impact, obviously, on asset inflation, because as long as interest rates fell here in this period, 1980 to 2008, when a bubble burst and you printed money, it didn't lead necessarily right away to inflation. That may be different going forward. It could lead to rising inflation and rising interest rates. I'd also like to mention that even if we were successful in implementing hard money, we could still have bubbles. Say in this room, it would imply hard money that the supply and the quantity of money is limited. Say we would have a gold standard. But if someone discovered a major mining deposit over here, say like in California at the middle of the 19th century, then money would flow from the back of the room and people would flow from the back of the room to take advantage of this newfound profit opportunity there, and therefore prices over there would have a rising tendency. There'd be a bubble, like railroads or canals, but because the money would come out of the back of the room, there'd be deflation at the back of the room. So if you look at the bubbles of the last 200 years, usually they were concentrated in one region of the world or in one sector of the economy, like the TMT sector bubble in 2000. It wasn't the stock market bubble, because shipping stocks were depressed, oil stocks were depressed, mining companies were depressed. All the old economy stocks were depressed. It was just the Nasdaq and technology, media, telecommunication stocks that were in cuckoo land. So also Japan, 89, we didn't have a commodities bubble. We didn't have a US stock market bubble at that time. All I'm saying, bubbles can occur even under constant money or sound money. But